What's up, Gould Miners? Man, have we got an episode for you today. I have the privilege of interviewing Sam Silverman, who has quickly made a name for himself in the real estate space. Sam has raised over $70 million in private capital to place in real estate syndications and funds, and he has invested himself into over 60 deals as a limited partner. Not only that, Sam has an impressive resume. He is also a founding member of TechVestor, which has established itself as a highly reputable real estate fund focusing primarily on short-term rentals and Airbnb. Oh, and did I mention? He's 29 years old. This guy is super impressive, and in this episode, we cover a wide array of topics, starting from how Sam built his financial foundation and set himself up to never have to work again by the age of 28. We then pivot into a conversation around short-term rentals, the trends that Sam is seeing in the short-term rental space right now, and what TechVestor has done from an investment strategy standpoint to protect itself from falling victim to things like Airbnb fatigue or the various metros that have decided to impose sanctions on short-term rentals. And finally, Sam shares some phenomenal advice for anyone who's just getting started in their real estate investing journey. Whether you are a passive investor or even if you're looking to take on a more active role, Sam has some really great advice for you. This one is an absolute gem, everyone. So let's welcome to the show, Sam Silverman. Sam, welcome to the Gould Mine.
Cool, man. Thanks for having me on.
Yeah. So been seeing you online now for a long time. Clearly established yourself as a thought leader specifically in the commercial real estate space, the capital raising space. Someone just tuned into this podcast. They've never heard of Sam Silverman before. Why should they pay attention to this episode?
So on my end, there's a few businesses that I run that I think are impactful looking at the real estate space and just capital raising in general. So on my end, over the last 2.5 or so years, I've raised close to $70 million of retail investor capital for private placements, syndications, and funds. So all working on the investor side of the house, kind of very, very niche in that area. So by trait, not an operator, much more so on the capital side of the house. And I've gotten very, very, very deep versus wide.
Okay. Well, why don't we start there, because you weren't always doing this, right? And so can you recall like that aha moment where you just decided, hey, I'm going to do this? Like, what was that switch that flipped inside of you?
Yeah. So I started prior to being in real estate in the sales world in tech. So I worked on the outbound sales side where I was going out hunting for new logos, right? Inside sales, where I spent a lot of time on buyer profiling. So quickly can work my way up, ended up building a team in a new company from zero to 120 employees over about a 2-year period. And that team's their sole job was, here's a list of our current customers, go find accounts that look similar, and go find executives of those accounts that look similar to buyers who have bought from us in the past. So I'll tie that back in a second. But from there, started buying single family houses. Built a portfolio of 9-10 houses, realized I absolutely hated doing it. And for me, being in sales, it's a field in which you can make 3, 4, 5x what your package says you should make. It's also a field in which you can get fired for performance the next quarter and make far less than you should if you don't perform. So for me, when looking at the single family side of it, it wasn't worthwhile enough to not put more effort in my day job. So from there, sold the portfolio off, got into LP investing. I think I invested into like 20 deals over about a 9-10 month period, and then realized quickly that 2 things actually matter, right? To get equity into a deal. One, you find a deal. For me, I wasn't going to do that, right? Like it didn't fit to my skill set, didn't fit to my time bandwidth. Second, you find money. That fit very well when looking at the skill set I had in terms of investor profiling, hunting for new leads. So basically taking all that tech and sales knowledge and applying it to building out investor lists and leveraging those connections I had for investing as an LP with top operators to go build a business entirely around that.
So people who are listening to this podcast right now and not watching it on YouTube are probably like, yeah, that sounds awesome. But anyone who is watching this right now is looking at you, they're sizing you up and they're being like, this guy's like 18 years old. Like, you look super young. And by the way, like I get that all the time too. It's like, how have you managed to do so much in so little time? Like buying 10 single family homes is no small feat. Then liquidating that, putting it into like 20 different syndications, funds, whatever. How did you find success at such an early age? And what can you attribute that success to, Sam? Because it's pretty impressive, man.
So I think people, when they first get into like their careers, they start looking at these side ventures, it's really easy to get distracted. Like for me, I knew I need to work for myself from the day I started working. I built businesses when I was super young, like even before college as well. And I knew that at some point I'd go work for myself. So in that period of time, the only thing I cared about was making money because I knew this was not what I wanted to go do. But in the interim, the more money I made, the more optionality I had to go bigger or quicker when I figured out what I actually want to do for myself. So those 7 years I was in corporate America, I was working 80, 100 hours a week. Most people don't want to make those kind of sacrifices to go get to a place they want to go to. So for me, like I was in isolation in my office Monday through Sunday every week from 6 a.m. to 10 p.m. every night, besides the gym and lunch and doing a few things here and there. Like that was it. That was all I did, because I was in roles in which they'd pay you the more you performed. And in sales, especially entry-level sales and kind of starting out, it's a volume game, right? In sales, it's a equation. What's your output times what's your conversion? And until your conversion is really good, you can outwork it. And for me, that's what I did. So in turn, I was that kid picked out of the mailroom, right? And when looking at, I was a top person in my company of 50 plus people in my role. Every single month I was there, right? And then in turn, I got hired to a executive role at 23 years old in a public company to go build out a 100-person plus team. And for me, it was finding someone in leadership who would go bet on you. Because the way I think about it is that, say you're a 6 out of 10 in something, right? If you keep doing that same thing, you're likely to stay a 6 out of 10. But if you force yourself in scenarios that requires to be an 8 out of 10, and you can accomplish that, you're now an 8 out of 10. So in turn, I worked my ass off to go find people who would take a chance on me, to give me the opportunity of putting myself in positions that required me to go level up, and in turn, make far more money in doing so. So a lot of it was, 1, busting your ass to do really well. 2, building relationships and with people that will go bet on you in senior type roles. And what that looked like was, I think a big thing people miss really frequently is, what's your ratio? What do you do versus what do you say? The better that ratio is in terms of completing the shit you say you're going to go do, makes it a lot better for people to go trust you with those things. If you're a senior leader at a company and you have people under you, like think large teams, the biggest thing you can go have in your corner is when someone says, I got this, they actually go do it. And you have people who will say that and they don't do it, that then lingers on your plate mentally until they actually get that shit done. So for you as a employee or a leader in a bigger company, if you say you're going to do something, go do it, right? And if you can hold yourself accountable to that, and your leader knows that, you'll get opportunity to go follow that, because you make their life easier. So to kind of close the loop here as well, when I still had my last day job, which was a VP of sales at a company called Prometric, right, running a multiple region division, I built my entire investor base and investor list in doing so. I was actually working 2 full-time jobs. So for me, I saw a light in the tunnel where I can go sacrifice a period of years of my life to go be fully financially independent, just turned 28 years old, right? I would never have to work again in my entire life. Like I could stop today, live exactly how I live right now, and not do a single thing ever again. I would go nuts in doing so, right? Like I need to go do things, but yeah, I was okay making that period of sacrifice to go be in a position where I'm now entirely set for whatever I want to do going forward.
Would you say that, because you've always had entrepreneurial tendencies, right? So it could have been very easy for you at, say, age 18, 20, 21, 22, for you to go out there and start your own thing. But you took some years there in the middle between, the time that you graduated high school. You went to school, presumably?
I did, yeah. So I was 21, leaving college, getting kind of like my first entry-level like tech sales role.
Yeah. Okay. So you went to college, came out, instead of going back down that entrepreneurial path, you opted to go with the corporate path, knowing that one day you'd return back. Do you think that if you had to reflect back on it and everything, you use that corporate job to essentially create enough cash flow and enough of a financial foundation so that you never have to work again in your life? Like, if you had done it the opposite way, do you think that you'd be further ahead right now, at the same place, or behind? Right? Because like,
definitely not the same place. So either way ahead or way behind.
Yeah.
Right.
Yeah.
There's no middle ground in that sense. So I have tons of friends who have gone the let me go build a small tech startup type thing. That's really boom or bust. Right. So for me, the likelihood of achieving goals was always needed. Right. I didn't come from a family who had money to go support you. Right. It was, if you go strike out, that's it. There's no fallback in terms of having a safety net. So for me, taking the corporate route, I think actually helped me a ton in what I'm doing today. Right. The skills you learn of leading teams, managing people, understanding how to go sell. If you can understand how to go sell and understand the psychology of how people buy and how they think and operate, you can do whatever you want to go do. Any company you go start, if you're not your best salesperson at first, like we've all watched Shark Tank. Think of someone going on there and like, have you sold anything yet? If the answer is no, there's no shot they're getting a deal that the person buying their entire company. So at your end, you need to get it from 0 to 1, right? Understanding how to go sell. So for me, that was always my background, my competency. I was running sales teams at 14, 15 years old for event planning companies that I built. And I knew I can go sell. So until I figured out what I actually wanted to go do, I'm like, I'll make as much money as possible, live below my means, park capital in places that actually make money, and go take those bets. And they panned out mostly really well. So yeah, I think to answer your question, either very far ahead or at 0. And I think if I was at 0, knowing what I did at 21, I probably could make it back. Now I'm in a place where going to 0 doesn't scare me at all, right? Because those skills that you've learned along the way of doing yourself, you can't have those taken from you.
Yep, 100%. That is 100% true. And it's interesting because, right now I feel like we're in that that time period right now where the information is so readily available out there. And it seems like, everyone and their mother wants to be an entrepreneur. And, but it's kind of refreshing to see, your journey. You obviously had entrepreneurial tendencies from a young age, but you built that foundation before you really jumped into this next chapter of your life. And I think it's brilliant, dude. I think it's really smart. And I look at a lot of people that didn't do that, that just went straight into their entrepreneurial journey. And it's more often than not, they're exactly as you said. They're still at 0, very, very close to it. And of course, there's lessons learned along the way, but it's very interesting to kind of have this conversation with you, because I think it's a road that probably more people should explore. And
it's
so
something
I think it's awesome.
Yeah, and it's something too that I give you an example. I had a buddy in college, came from a lot of family money, and he started day trading, right, and leveraged part of a family portfolio, and he had some incredible runs. But for him, a focus was, how can I have a big run and take massive swings where if I hit, I'm good? And in turn, when you take swings like that, likely with a lot of leverage when looking at the stock market as well, and you miss, you're at 0. So for me, by investing, I started investing at 23, maybe, or 22, 23. And I knew that if you look at a compound calculator, if I just don't mess up entirely, if I don't have strikeouts, if I don't double plays, if it's walks and singles, I will be set, beyond set long term. So for me, I was more concerned with the likelihood of success than maximizing every single dollar possible. Because for me, when leaving my day job, right, I hung on to my day job probably more than some people would in my position. The year I left my job, I raised $40 million of private capital, right? And that's with a mid to high 6-figure VP level role at a 3,000 person company on top of that. So I hung on longer than most would, because I knew once I left, I could never go back to it. So for me, the likelihood of success and kind of that freedom piece of it mattered more than making a few extra bucks in certain scenarios and going for bigger risk profiles.
It's incredible, man. And I think that any young person who's listening to this episode right now who should be taking notes, because this is a very fresh perspective that I think people should be paying attention to. Let's flip gears a little bit, Sam, because you keep saying it's $70 million in capital raised, private capital. You raised $40 million of that when you were working another job. What strategies did you use or have you used in the past or are currently using to raise that kind of capital? And on top of that, what is it that you do that keeps investors coming back?
So when looking at kind of how I built out my entire investor lists from scratch, it was all things that I learned in the sales world, right? One is understand who the niche of investor you want to have. For me, it was people who are in high-end selling roles in tech or software or senior leadership roles on the sales side in tech or software. So second is figuring out, okay, how do I, what's my story for these people? How do I have a common connection with them? For me, I was in that exact same seat at that exact same time. It was a peer-to-peer conversation then. So it wasn't coming off as some investment sales guy. I was coming off as someone who was like, hey, I'm in your role. I have zero money in the stock market myself. I'm in 20 plus of these projects myself. My own money was there with these sponsors prior. I have a story for them. It's very compelling.
Mm. Yep.
Third is figuring out how do you get in front of these people at scale? I hate conferences. I think conferences are the biggest waste of time in the entire world, right? Being podcasts like this are great for credibility and sharing your story. Horrible for attracting investors, typically, right? Most real estate podcasts you go on are really bad for the person going on there to go attract investors. Great for credibility, but if you want to go be somewhere where you're the only real estate person, the only investment sponsor in that area versus being a credibility type play, this is great for credibility, right? So I think that understanding your avenue of what you're looking for is really important. There's huge value in both, but understanding what that is first matters. So for me, my avenue was LinkedIn Sales Navigator. I can go build a list of 100,000 people who fit my investor profile. And by their profile, I can tell you, this person probably makes roughly this. You can sort by company, location, seniority, what their role is. So building out lists of people, and in turn, going and adding them every week, you get 150 connection requests a week. So when you think of your LinkedIn network, building an audience around you who actually fits the profile you want to go speak to, it's insanely important. Because if you look at your LinkedIn, your Facebook, whatever social media you have, and you're like, okay, of these people on here, what percent fit the profile that could be a customer for me in some kind of business that I have? If it's low, go reevaluate what you're doing there. So for me, LinkedIn Sales Navigator could build targeted lists. And then I ran teams of 100 plus people where their sole job was go book meetings. The exact same process works for people that you're targeting, especially targeting salespeople, right? If you're in sales and your LinkedIn dings, you are running to that page because there's likely money there for you, right? Your prospects, your buyers, right? So your message visibility is extremely high. So it's building out a process to go attract investors there. And lastly, it's understanding, how do I understand the psychology of how people think and operate and actually get them on a phone call that shows you're credible, right? Using podcasts like this to go say, hey, want to hear my story? Go listen to the Gould Mine show, right? Go listen to this. So you're leveraging things like that for credibility and articles you write and stories you share. So that when someone talks on the phone, it's a warm conversation. By listening to your show, I'm sure you've had investors, you talk to people you work with, that they hear your show and they never talked to you before. They get on the phone with you like, oh, I feel like I know you already. I know how you think, how you operate, who you are as a person, right? It's much warmer in that sense. So to recap, it's who's your profile? What's your connection? How do you reach them at scale? How do you run Facebook meetings with them? How do you make it efficient to actually run a call, share content with them, and get in front of them?
You said something at the very beginning of that struck me. You're like, I'm invested in these deals myself. So you're not selling them something that you've already put your money there, right? Your money is where your mouth is, kind of thing.
I have which is zero in the stock market. Literally, not a single dollar.
Yeah.
Right or wrong, it's just the truth, yes.
I don't think it's wrong. Honestly, I think that the stock market, it's Yeah, it's like one of these stories that like kind of was a generational thing. You know, the stock market was really like a baby boomer thing, and I think that now there's a lot of people in our age demographic that are staying away from the stock market or diversifying into other things now, whether it be funds in commercial real estate or crypto or whatever. Which again, I have almost nothing invested in either. But it is interesting. It is interesting that that you chose to invest first, share your success with other LPs, and then through that create a fund of funds. So your fund helps investors create wealth passively. Can you elaborate? You know, for those who are listening right now, or that are not as familiar with this concept of fund of funds, like, can you elaborate on what that looks like, what that means, and why you've chosen to operate it this way?
Yeah. So when looking at raising capital as a profession, right, you have 3 different avenues you can go down to raise capital when looking at compliance with the SEC. So all of it stems from what can you legally go do to earn compensation. So one, you can go, and this is not legal advice anyway, but like one, you can go the route of being a registered rep through FINRA and hang your license with a broker dealer. What that means is you can be legally paid to raise capital for commission. I didn't choose to go that route. Second, you can go be a co-general partner in a project where you're earning a piece of equity for a contribution to the group, whether that be for raising capital or whether it be for other roles you have in that group. Or third, you can go the fund of funds route. And what that means is that you get better economics investing a larger check of capital. So for example, if a retail investor, right, like you or myself just investing in this deal just kind of on our own, investing say 50 grand, they may get a certain return based on the preferred return and the profit sharing split there beyond that. But if you're investing, say, 500 grand or $1 million that you aggregate from your investors, you may get better economics. So in turn, you can pass along those same returns to your investors. They get going direct, if not better, and make that spread between those classes of shares. So by your job as a fund-to-fund manager, you're negotiating better terms, you're kind of owning that due diligence responsibility for investors, and it's a way you can be compensated for raising capital indirectly through managing your fund. So the intention there is, one, to make sure you're compliant with the SEC, and two, to really help your investors, in terms of getting good opportunities in front of them, they can go work with. So on my end, I knew that diversity mattered to me more versus being Sam, the guy who does multifamily deals in Texas, right? I want to be Sam, the person who brings my investors great deals in different asset classes. That way I can go focus on finding great partners who do deals in a certain area, right? They have expertise in their asset class, their area, their market. That way I can work with the best in every asset class. Because for example, I probably invested in, I've been storage deals, multifamily deals, debt, mobile home parks, short-term rentals, RV campgrounds, right? Because each one of those deals solves a different type of thing. And also depending where you're on like a market cycle, some things make more sense than others. So it depends. So my goal is to be able to provide investors different optionality to solve different pain points, myself included, right? So there's more stuff that I was interested in, I pursued, and I'm like, okay, investors probably think the same way as well, at least part of them.
When you're talking about retail investors, LPs, and let's say that you've got a couple, we have passive investors, LPs that are listening to this podcast right now. So you've listed some of the benefits of a fund of funds, which is larger check sizes means more negotiating power, more leverage, right? When you're sitting at the table with the GP. And there's the ability to diversify amongst different asset classes, et cetera. What would some potential drawbacks be, if any, when it comes to like investing into fund funds?
Yeah. So as a retail investor investing into a fund of fund, there's a few things you need to understand too. The fee structure, right? Because you have the actual deal level fees and you have a fund level fees as well, right? Because the fund manager themselves gets compensated. So understanding how people are getting paid and how it shakes out is important. There are also back office costs for a fund of funds, right? So you have legal costs, each deal you're doing, you have back office costs in terms of K1s, reporting, et cetera. So as long as you have the whole picture of what that looks like, right? Fee structures and overall return packages. Like for example, I run a fund called TechBuster. We're probably one of the largest owner operators in the STR space, short rentals, think Airbnb properties, right? Our fund managers who raise capital on our behalf and partner with us, they can actually offer better returns to their investors versus them coming to us directly, because we're built specifically for fund-to-fund capital. So understanding what that structure is and why it makes sense is really important. So the fee structure, the return profiles, right? All of that, the risk associated to it, the back office costs, have them break it down for you, right? Like they should be able to speak to it offhand very easily. If not, likely look somewhere else to go invest.
You mentioned Airbnb and short-term rentals, and I think this is a good time to kind of pivot, transition into that, because I do know that you have some investments in the STR space. A couple things. I think the first question that I would have is, and I'm not sure, Sam, if this is like a local to the Bay Area thing, but like, for example, I can just speak from my personal experience. 5 years ago, everyone was using Airbnb. Like everyone was like, hey, like, what Airbnb did you, no one asked like, hey, where are you staying? It's like, what Airbnb are you staying in, right? Like everyone was just kind of used to going and staying in Airbnbs whenever they traveled. But recently I've been talking to a lot of my friends, my colleagues, et cetera. And there seems to be like this almost like Airbnb fatigue, right? Like people are getting a little, yeah.
Of your friends, what's the demographic of people going? Is most like single people, couples, kind of one or two off people typically?
I would say the majority of them are younger, so like around my age, and the demographics kind of span, right? But the majority of them are going to be, dinks, dual income, no kids, right?
And it's mostly the two of them going at one time, right?
Correct. Or sometimes they travel with groups, but like the majority of them are, and by the way, this is not a scientific study, right? This is just my general feeling.
I'm going somewhere with that though, right? So like we don't go compete with the hotel market. If I'm traveling with one person, I'm staying in a hotel, right? Our goal, like when you look at the hotel markets, it's much more so bigger cities and major metros. So a few things. One, they're most likely to be impacted by regulations. Two, economics don't make sense. Three, the biggest benefits of short-term rentals is the common space that you have, and that only plays up if you have a group. So of our stays, over 70% of our stays are 6 guests or more. Over 30% of our stays are 10 guests or more. So we're catering to a different audience with that in mind. So for us, we focus on providing a great experience amenity-wise, but also comparable costs per head when looking at staying in a larger place. So if you have families, you need common space to cook, to have social gatherings within that, it makes a lot more sense. So if it's one person, 2 people off going to a major city, it rarely makes sense to use an Airbnb. If it's a larger group, it makes sense all day long in that sense. Also, kind of thinking of short-term rentals, like you said, people are like, what Airbnb did you stay at? They're branding that entire market through Airbnb. And for us too, I think 92% of our bookings come from there. And when thinking about it, if you're a good steward of their brand, right? So say you stay at a house that we own, you're like, this house was awesome. You're looking to say this Airbnb was great. So in turn, you're more likely to go book another Airbnb in the future because your experience was positive. So people that give quality experiences there rank extremely high in SEO. And in 3 major markets that we're in, open a page of houses that sleep 10 guests or more, we're probably the first 8 or 9 out of 10 on those pages. For that reason, if you're a good steward of their brand, they reward you in spades in SEO rankings.
Understood. So from what and by the way, everything that you just said there makes a lot of sense, right? Like, so you avoid buying properties that are like that can sleep less than 6 or 4, right? Which makes a lot of sense. You're staying away from larger metros, which you answered the question that I was going to bring up, which is like all of these like, rules and regulations that are being brought upon the short-term rentals. And the other question that I have here for you though, when it comes to Airbnbs, and it just kind of piggybacking off of what you just said, when you're looking at the fatigue, I think that some of it, right? So a lot of the feedback that I've been hearing amongst my like inner circle is not just like the fact that it's the fact that it's like more convenient when you go with like 6 or 8 or 10 people. Like the convenience thing makes sense at scale. But one of the things that I keep hearing is like, the fees, right? Like the hidden fees, it's just tired of like, having to pay all of this extra money. How have you, like, what are ways that you are like actively kind of combating that stigma?
We price probably the top 20% of the market all day long. We command far higher pricing than most people actually for our properties. So the people who are staying in our properties are more concerned with experience typically than they are with overall price point, right? So we typically price in the 80 to 85th percentile, depending what that looks like, right? So for us, it's all a combination. When you look at like, people always ask about occupancy or ADRs, and it's a half stat, right? Your sole focus is how do you drive as much revenue as possible most efficiently? Because people look at, say, occupancy, for example, like you're 6% occupied. Why? Right? You're more concerned with the overall revenue that you drive, which is a combination of what's your occupancy times your average daily rate, right? Which is RevPAR. So really focused around that. So in terms of like pushback on fees, we don't see it, right? Like people will negotiate with you at times, but if you actually set yourself up the right way, always focus around booking lead time too. So we have data down to the day of, if people check in on this date, how long should they have to stay, booking far out, right? So like you may see that someone coming in on a Saturday, they need to stay at least 5 days to make that booking profitable for you in that sense. So you're pricing things the day based on how far out they are, right? So we have a full team that manages all of our pricing and revenue management for things like that to go maximize overall dollars for our portfolio.
Yeah, so that makes a lot of sense. And by the way, that level of oversight and management is crucial when it comes to maximizing, any type of transient.
It's also It's also super important too when you think of who's your end buyer of your portfolios in the future, right? Mm-hmm. We know our buyers are 90% chance is going to be a large institution looking to go buy hundreds of doors at one time. Mm-hmm. So for us, we have institutional level reporting already. We can tell you down to the penny of every single thing that we do, all categorized based on trends, data cycles, etc. An institution will have more confidence going into it saying, this is their performance. This is how we can go predict the future performance based on what they have as well. So we have everything mapped out down to a science in terms of data. And we're building it as if we are, far ahead of where we actually are today.
That's awesome, man. Honestly, like just hearing you talk, I'm definitely way more involved in the hotel space than STRs. There's definitely a lot of similarities in what you just said, like thinking about who's the end buyer, right? Whenever you're buying something, you got to think like, what's the exit? And what are we doing right now to kind of prepare for that? Because whether it be a 5, a 7-year hold or a 10-year hold or whatever your underwriting is geared towards, you have to have that insight in mind, because otherwise you're going to be stuck with a bad asset or something that you can't offload. It's really important. And so anyone that's listening to this podcast right now is like, should be taking notes, because these are questions that you should be asking your sponsors or like people that you're investing with. Is like, hey, what's the exit strategy and what are we doing right now to prepare the asset for that exit? Switching gears a little bit, Sam, the market right now is very challenging for a lot of people, the real estate market. So what are you seeing right now in the market, and what are you doing from a tech investor standpoint to kind of like hedge, but then also like the fund of funds? What deals are you looking like? What are these conditions doing in terms of opportunities that are being presented? And also, what are these conditions doing in terms of like your capital raising efforts? Because I hear a lot like, oh, it's hard to raise capital in this environment. So really curious. In order.
I'll go in order of those. So first, I'm looking at tech investor. We really focus on, and the fact that we can go buy so frequently, right? Mm-hmm. We can get really aggressive on offering and walk into a good basis property pretty frequently. Right? And finding people who need to exit properties. We're getting quality basis right now in deals. Also, in looking at how do you protect yourself from downside in the future, all of our debt is fixed for at least 10 years. Most of our debt is fixed for 30 years or more. So for us, we operate at roughly a 3x debt service coverage ratio, meaning we have roughly 3 times net operating income versus our debt cost every month on average. So for us, we look at fixed rate debt, quality income to go cover your debt. You can hang on to your property longer than you have to. And what I mean by that is that we model 5 years. We get paid when we sell, right? It's how we get paid as sponsors, right? It's how we make bulk of our money. But if we have to hang on to assets for 6, 7, 8, 9 years, to actually make sure investors' capital is protected and preserved and performs well, we're putting things in place that allow us to go do so. So right now, we're very concerned with how do we go protect downside protection for investors. But looking at the deals we're looking at on the capital raising side of the house outside of TechBuster, they're all focused on different types of things. Multifamily right now, we're kind of very strategic how we're looking at deals. Those deals we're participating in have to have a good story, right? Right now, it's typically seller distress. They may be on a bridge loan that's coming due. They may be retiring and want to get out of the business for a long period of time, right? There has to be some level of a story that the deal is distressed in some way that you're buying. So part of that too is that typically the story helps sell the deal as well. Because if you're raising capital, you one, need a good deal, two, need a good partner, but three, the deal still has to have a good story to it, marketability for it. For example, there are deals I've turned down that are actually great deals because I knew my investor base wouldn't be receptive to that type of market, deal, structure, whatever it may be. Regardless of how good the deal is, you can actually raise for it successfully. It's like being a salesperson with a great product, but no one will buy it, right? It's understanding what that looks like for you. And lastly, I'm kind of looking at the capital raising piece of it. It's definitely hard to raise capital right now, right? I'd say every dollar you raise in 2023 was probably $2.5, $3 in any other year in terms of level of effort. So on my end, I actually built a community around this as well called Fully Funded, where our sole goal is helping capital raisers get better at raising capital and operators finding partners to go raise capital for their projects. Because right now, my opinion, deals are better risk adjusted than they have been in the last few years. And when I say that is I take multifamily deal, for example, your traditional Class B 80s to 2000 product that's being flipped by syndicators, right? Those deals may model to a 14 to 16 IRR, right? Give or take to investors. And those same return profiles were the same 2 years ago. And with variable rate debt, higher leverage, so your likelihood of actually achieving those returns, you get more upside, also way more downside. I'd say in a basis factoring in risk, they're actually better deals right now than they have been. People just have less cash on hand right now. And there's more fear macro-wise overall between it's an election year, what's going on with the Fed, there are wars in other countries right now that we may or may not get involved in more capacity as well, right? Trade issues going on. So I think all those things apply to how people feel on a macro level.
Everything you said is 1000% true when it comes to like the fear that we're seeing in the marketplace right now. I'd love to know, when you're having those conversations, this is maybe more of a selfish question, right? So when you're having those kinds of conversations when someone brings those things up, brings them to the table, like, how are you handling that? How are you handling those objections and those concerns? Or are you even having those conversations, right? Like, I'm really curious.
So like which objections? Like we can role play it out if you want, like which one if you want to go.
For example, I was like, Sam, we would really love to, but, kind of holding things a little closer to vest right now because of all the things that are going on in all the foreign wars that are happening right now. We'll start there.
So on our end, like our goal is to help find something that makes sense for you, right? Yeah. For us, we focus on investments that have different types of liquidity, different types of upside, downside protection. So for you, if you're really focused on making sure you have capital to hand when something happens, we have an option for you that actually has liquidity within 3 months. So for us, like we pride ourselves on diversity. So what we can do is if you want to have capital you want to go park for a period of time that you may or may not need in the future, but you're more concerned with how you feel comfortably about having that capital accessible, we have an option for you where you can go out earn a money market account, right, by at least a few points, but still have access to your capital when looking at that, right? So I think it all depends on how you structure yourself and kind of what you're doing. So you can kind of pivot each way with investors. By being a capital allocator versus truly deal sponsor, you have a lot more latitude in that sense. So part of it is picking up on what's this person's sentiment and what they're doing, right? The alternative route you can go is, because of all these things going on in the macro environment right now, we're seeing better deals than we ever have, right? This could be that 08, 09, look at someone's track record, and these deals reflect outsized performance. People joke about it saying, hey, you bought those deals in 08, 09, they shouldn't even count in your track record, right? This may not be that severe, but we also may not be too far off from it too. So like you look back to the, Warren Buffett quote, right? When there's fear in the marketplace, you go a lot heavier, right? Like you buy when there's blood in the streets. So it's a you kind of wait all this time to go invest and do things. And now this is the opportunity you have and you're kind of pulling back. I mean, that's entirely up to you, but it's something that if it were me and I'm looking to really grow, especially if you have a longer term horizon, like now's time to go bet bigger.
I love that. That's awesome. That's really, and it's true, right? Like everyone, it's so interesting, having been on both the residential side of things and like the commercial side of things. It's like everyone's waiting for things, for the prices to get better, for like the market to correct or adjust. And then the market corrects or adjusts right in front of them. And they just like are too scared to do anything. So it's super fascinating, right? Like human psychology, everyone wants the shit to hit the fan, so to speak. But then when it does, everyone's like, run, Even
look at the stock market too, right? Like if you, and this is like the things I've seen, I haven't looked into too much, but if you look at the stock market for a big period of time, right? It's big historical averages. If you weren't in the stock market on certain days where it had those huge jumps, you're in the red, right? So like being in when things are down actually gives you a good chance that them come back up. But also making sure getting to deals that have the downside protection covered, right? Like the fixed rate debt, like being in a place where you have good, quality cash flow to go cover future expenses and buffer room there as well, will allow you to go ride those downtimes out to get to places of stability.
Yeah, I love that. So one of the things that I observed in just kind of like the way that you're describing your fund of funds, like you are diversifying, the portfolio is, and I don't know the answer to this, so I'm just like genuinely curious. Like I'm assuming that if someone comes to you and says, hey, I want to invest with you, they're not necessarily allocating to the fund for you to decide like.
No, that gets into the whole, laws about being an investment advisor. Yep. They are investing into a single project or asset based on what was presented to them. So it's not as if they're saying,
gotcha.
Hey, I'm Sam, give me capital, I'll go deploy it how I see fit. If they have a clear idea of what the project is, the deal itself, et cetera, going into it.
Gotcha. Okay. So you're basically like, for lack of a better word, you're raising the capital, soft committing, but then participating in syndications on a one-by-one basis. Like you're syndicating.
So I'm raising
the deal,
capital
so
on a deal-by-deal basis, right? So I'm not going like, I have this list of $10 million committed to me that I can go allocate how I see fit. We're launching deals to our investor base based on what we have in terms of pipeline.
Makes a lot of sense. That makes a lot of sense. So switching gears a little bit, Sam, when you were starting out on this journey, obviously, like you built a single family portfolio, you liquidated that, invested it into syndications and funds. Like if you're a 21-year-old right now, you're listening to this podcast, what advice would you give to someone that's just at the very beginning of their real estate investing journey?
How much money do they make in their day job if they have one?
Oh man, that's a good question. Let's just say $60K. Like let's just say
every dollar
right now
they spend to be focused on how to make that $60K, $250, and $250, $500. Your biggest return is in making more money in your day job at first.
That's fair.
So like investing in education and actual skills, probably not.
Yep.
If it were your bigger focus, like should only be, I didn't invest at all until I started making $250,000 a year. Because I knew that every second I could spend was better spent in my day job making more money. So I'd say if you're making $60,000 a year at 21 years old, nothing's wrong with that, but go figure out how that scales when you look at your career versus how do I go make, because what do you got, 10 grand, 100 grand? Even if you have 100 grand to go invest, you make 7% versus 12%. Who cares? It's $5,000, right? Like not saying anything is wrong with that. That time is better spent getting your education to a place and learning skills to go make more money. You have more to go allocate in the future.
I would absolutely agree with that. Now, to piggyback on top of that, though, like let's say that someone wants to get into more of like an active role. They're looking at what you're doing right now and they're saying like, wow, I'd really love to do something like what Sam does, right? So what advice would you have to someone that's actually looking to be a little bit more active with their, with their trajectory?
So that's part of why I created Fully Funded, right? We help people understand, we really target 3 types of people to join our community. One, the active deal sponsor, people actually raising capital for their own projects. They find value by learning how to raise more money in places like LinkedIn, finding capital partners. Second is the capital allocator like myself, learning how to raise more capital for yourself, but also how to go vet partners, right? Third is the person looking to go learn how to raise capital. And for them, we have a huge educational curriculum on how to actually go build your business, how to go avoid a lot of the mistakes I made at first as well that I would have paid a few extra zeros to go avoid, right? So I think a big piece of it is your money is better spent in education until you're at a place in which you can really go pump meaningful cash into a portfolio of something. So I'd say whether you go to a program like mine, whether you go do something else, like figure out how to make more money consistently and or build sweat equity into deals by legwork and hustle, right? Like those two things will get you much further. But if you're looking to go break into real estate in some capacity, do two things, one of two things. Learn how to go find deals or learn how to go find money. Whatever you do, learning skills of sales and raising money will help you no matter what.
100%. 100%. You know, it's interesting because like, you know, obviously I have a sales background as well. And I would say the vast majority of the people that I've had on this show that are either sponsors or capital raisers have a sales background. I wouldn't say all of them, but like the majority of them do. And it's super fascinating how those skills translate over so well. And so I would even piggyback and say like, hey, if you're working that job and you want to if you want to be an active investor and you don't have a sales position, you don't have any sales skills, I would absolutely find a way to either get a sales job, like you said, invest in some education or something that's going to teach you how to become a better salesperson, because those skills translate 1,000%, and no amount of like money is going to be able to replace that knowledge. If you can sell, you have insane career, stability. You have zero job stability, right? Like I've been in sales, I've seen people get fired, like shit happens, right? You're one quarter away from a 6-figure check, one quarter away from you for being fired on performance. But if you can go sell and have that understanding psychology a little bit, understanding any people to do what you want them to go do, and they feel as though it's their choice, right? Like that's the most powerful thing in the entire world. If you can want someone to go do something and walk them down a path that they end up feeling like that's the best thing for them to go do on their own, nothing is more powerful than having that skill. By the way, if you're listening right now and you're interested in any of anything that Sam just talked about, whether it be TechVestor or whether it be fully funded, we're going to have all those links in the description boxes below. So you can find all that information down below. Sam, we're coming up on time. Thank you so much for your time. This has been awesome. But in traditional Gould Mine fashion, we're going to have you leave the audience with one final Gould nugget.
Oof. So honestly, if it were me, I'd just spend, if you don't have any kind of sales background, like spend some time learning sales, right? Like learning sales, learning a little bit of psychology stuff, right? Like no matter what career you go do, it won't hurt you, right? Psychology Money is a great book. Persuasion's a great book, right? Like spend the $15 on Audible to have someone talking to you, right? Like spending money on education in terms of the sales world will benefit you in every aspect of your life, right? Whether it's making money, whether it's dating, right? Like whatever it may be, understanding how to get people to do things that you want them to go do and help them guide them on that path is so valuable. So psychology and sales will pay you in every aspect of life if you spend some time learning it. Couldn't agree more. Sam, thank you so much for your time, my friend. Cool, man. Been fun.